ExamPrep.School, Colorado Life Insurance Producer Exam, exam code INSCO-Life1. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Colorado statutes, rules, and regulations, common to life, sickness and accident, property, and casualty. Colorado statutes, rules, and regulations pertinent to life insurance only. Completing the application, underwriting, and delivering the policies. Life provisions, riders, options, and exclusions. Retirement and other insurance concepts. Types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which best describes the net level premium method used in determining the annual premium for an ordinary whole life insurance policy? A. It sets premiums that increase annually to match rising mortality costs. B. It equalizes the present value of future net premiums with the present value of future guaranteed death benefits, using mortality and interest assumptions. C. It requires a single upfront payment at policy issue to cover all future benefits. D. It calculates premiums based solely on current mortality charges without interest adjustments. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The net level premium method calculates a level annual amount whose present value of future net premiums equals the present value of future guaranteed death benefits based on assumed mortality rates and interest. Reason A is not correct. Premiums do not increase annually, they remain level under this method. Reason C is not correct. A single upfront payment describes a single premium policy, not the level premium method. Reason D is not correct. Interest assumptions are integral to the net level premium calculation, not ignored. Question 2. Which statement correctly characterizes the premium payment structure of a 15-year limited pay whole life insurance policy? A. Level premiums are payable up to age 65, after which the policy enters a paid-up status. B. Level annual premiums are payable for the first 15 years, after which no further premiums are due while the coverage remains in force for life. C. A single lump sum payment is made at policy inception to fund the entire policy. D. Premiums are payable annually throughout the insured's lifetime. The correct answer is B. In a 15-year limited pay whole life policy, the insured pays level annual premiums for 15 years only, and the policy remains in force for the insured's lifetime, without further premium payments. Reason A is not correct. Limited pay does not relate to a target age like 65, it specifies a fixed number of payment years. Reason C is not correct. A single lump sum payment defines a single premium policy, not a limited pay policy. Reason D is not correct. Limited pay policies do not require lifetime premium payments. They stop after the specified term. Question 3. Which statement accurately characterizes the funding mechanics of a single premium, whole life insurance policy? A. An initial deposit is followed by smaller annual top-ups to build reserve over time. B. Level annual premiums are paid until the insured reaches age 100, then cease. C. Periodic installments fund the policy over a predetermined payment period, after which coverage remains in force. D. A lump sum premium at policy issue covers all future mortality costs and immediately establishes the full policy reserve. The correct answer is D. A single premium whole life policy is funded by one lump sum payment at issuance that covers all future mortality costs and establishes the full reserve immediately. Reason A is not correct. There are no subsequent top-up payments in a single premium policy. Reason B is not correct. This describes a limited pay or age-based pay policy, not a single premium policy. Reason C is not correct. Periodic installments describe limited pay plans, not single premium funding. Question 4. Which factor primarily accounts for the acceleration of cash value accumulation in later years of a level premium whole life insurance policy? A. Annually fluctuating dividend rates declared by the insurer. B. Incremental increases in mortality charges to match actuarial assumptions. C. The declining net amount at risk as policy reserves grow over time. D. Steady reductions in premium loadings over the premium paying period. The correct answer is C. As reserves increase under a level premium whole life policy, the net amount at risk, death benefit minus reserve, declines, causing more of each premium to accumulate as cash value in later years. Reason A is not correct. Dividend fluctuations affect non-guaranteed values but are not the primary driver under statutory reserve methods. Reason B is not correct. Mortality charges typically remain consistent relative to assumption and do not drive later cash value acceleration. Reason D is not correct. Premium loadings are fixed in level premium policies and do not steadily reduce over time. Question 5. At age 50, John reviews his traditional whole life insurance policy and notes that its cash value has exceeded the original face amount due to paid-up additions. Which feature of his policy's guaranteed death benefit applies when the insurer determines the payout at his death? A. The insurer guarantees payment of the original face amount regardless of cash value changes. B. The death benefit automatically increases each year by the cash value growth. C. The policy pays only the cash value if the insured dies after policy maturity. D. The insurer pays the greater of the face amount or the cash value at death. The correct answer is D. The guaranteed death benefit ensures the beneficiary receives at least the higher of the face amount or the policy's cash value upon death. Reason A is not correct. This distractor describes a minimum face amount guarantee, but omits the provision for the larger cash value payout. Reason B is not correct. This distractor confuses dividend additions and cash value growth with an automatic death benefit increase feature. Reason C is not correct. This distractor misstates policy maturity benefits. Death benefit is paid at death, not cash value only at maturity. Question 6. Mary's whole life policy has built a cash value of $20,000, but she can no longer pay premiums. She elects a non-forfeiture option that uses the cash value to maintain some death benefit indefinitely. Which describes this option? A. Cash value purchases term insurance for the original face amount until the value is exhausted. B. Cash value buys a fully paid-up policy with a reduced face amount and continued coverage. C. Policy lapses and the cash value is refunded to the policy owner. D. Cash value remains on deposit earning interest, but no death benefit applies. The correct answer is B. A reduced paid-up policy uses the accumulated cash value to purchase a new whole life policy with a lower face amount and no further premiums. Reason A is not correct. This describes the extended term option rather than the reduced paid-up option. Reason C is not correct. This describes the cash surrender option, which ends coverage and refunds cash value. Reason D is not correct. This describes leaving cash value on deposit but does not provide any death benefit. Question 7. Which of the following best describes the death benefit structure of a level term life insurance policy? A. A death benefit that remains constant throughout the entire policy term. B. A death benefit that decreases annually in line with the premium cost. C. A death benefit equal to the sum of cash value in a fixed face amount. D. A death benefit that decreases while the premium increases at each renewal. The correct answer is A. The death benefit remains unchanged from issue through expiration under a level term policy, distinguishing it from designs where the benefit changes. Reason B is not correct. The benefit does not decline each year in a level term contract. Reason C is not correct. Level term policies do not build cash value, so benefits are not tied to cash accumulation. Reason D is not correct. A level term benefit does not decrease at renewal regardless of premium changes. Question 8. Which situation most commonly illustrates the typical use of a decreasing term life insurance policy? A. Insuring a mortgage balance that amortizes over time. B. Covering final burial expenses with a level payout. C. Guaranteeing a fixed college tuition fund for a child. D. Protecting against loss of income due to permanent disability. The correct answer is A. A decreasing term policy is typically used to match a debt that declines over time, such as a mortgage that amortizes, ensuring benefit aligns with balance. Reason B is not correct. Final expense coverage usually uses level term to ensure a constant benefit. Reason C is not correct. College funding requires a predictable level benefit, not a declining amount. Reason D is not correct. Disability risk is managed with disability income products, not decreasing term life. Question 9. In an annually renewable term life policy, how do premiums typically change as the insured ages? A. Premiums increase each year based on attained age. B. Premiums remain level for a fixed period then rise at renewal. C. Premiums decrease annually as risk factors decline. D. Premiums stay constant if the insured passes periodic medical exams. The correct answer is A. Annually renewable term premiums are adjusted each year to reflect the insured's attained age, resulting in rising costs as age increases. Reason B is not correct. Level periods apply to level term, not annually renewable designs. Reason C is not correct. Risk increases with age. Premiums do not decrease in ART policies. Reason D is not correct. Medical exams do not affect ART premium adjustments by attained age. Question 10. A 40-year-old client purchases a 30-year return of premium term life policy that allows conversion to permanent coverage. The client converts the policy to whole life at the end of year 10. At the end of the original 30-year term, what condition must the client have met to qualify for the return of premiums benefit? A. The original term policy must have remained in force for the entire 30-year period without conversion. B. The client must have exercised the conversion option during the term period. C. A death benefit claim must have been filed and denied before maturity. D. The client must have surrendered the policy for its cash value prior to maturity. The correct answer is A. The return of premium feature refunds all premiums only if the original term contract stays in force through the entire specified term without lapse or conversion and no death benefit has been paid. Reason B is not correct. Exercising the conversion option terminates the original term contract, which voids the return of premium feature. Reason C is not correct. A death benefit claim prior to maturity would end the contract by paying out benefits rather than refunding premiums at term expiration. Reason D is not correct. Surrendering the policy before term expiration forfeits any future return of premium benefit. Question 11. A 45-year-old client holds a 10-year level term policy that includes a guaranteed renewable provision. At the end of the 10-year period, the client is healthy and does not wish to undergo another medical exam. Which of the following accurately describes how the policy can be renewed under this provision? A. It can be renewed for another 10-year level term period at the original premium rate. B. It can be converted to a permanent policy with no change in premium. C. It can be renewed without evidence of insurability but at a higher premium based on attained age. D. The client must submit proof of insurability to complete the renewal. The correct answer is C. A guaranteed renewable provision permits the policy to be renewed without new evidence of insurability, but premiums are recalculated using the insured's current age at renewal. Reason A is not correct. Renewal is not at the original premium rate. Premiums increase with age under a renewable provision. Reason B is not correct. Conversion to a permanent policy is a separate feature and does not guarantee unchanged premiums. Reason D is not correct. No additional proof of insurability is required under a guaranteed renewable provision. Question 12. In a universal life insurance policy, the flexible premium feature primarily allows the policy owner to do which of the following? A. Premium payments can be adjusted only on policy anniversaries according to a fixed schedule. B. Premium contributions are directed to a separate variable account subject to market performance fluctuations. C. Policy owner may increase or decrease premium payments within the policy's specified limits. D. Premium payments are used to purchase term insurance riders that automatically increase coverage. The correct answer is C. The flexible premium feature in a universal life policy permits the policy owner to vary premium amounts subject to the policy's minimum and maximum requirements, rather than requiring fixed payments or automatic purchase of riders. Reason A is not correct. Does not reflect the flexibility of changing amounts at any time. It describes a fixed anniversary schedule. Reason B is not correct. Describes variable life account allocation, not the premium flexibility of a universal life policy. Reason D is not correct. Refers to term insurance rider purchases, which is not the core flexible premium feature. Question 13. Which death benefit option in a universal life policy provides a death benefit equal to the face amount plus the accumulated cash value? A. Death benefit stays level at the original face amount throughout the policy. B. Death benefit increases to equal the face amount plus accumulated cash value. C. Death benefit decreases as the cash value accumulates over time. D. Death benefit equals total premiums paid plus guaranteed interest. The correct answer is B. The increasing death benefit option, often called Option B, in universal life insurance, sets the death benefit equal to the policy's face amount plus the accumulated cash value. Reason A is not correct. Describes the level death benefit option, not the increasing benefit that includes cash value. Reason C is not correct. Describes a hypothetical decreasing benefit structure, which is not an option in universal life policies. Reason D is not correct. Refers to a return of premium concept, not the universal life increasing death benefit option. Question 14. Harper purchased a universal life policy with a level death benefit of $350,000. At policy anniversary, the cash value had accumulated to $115,000, but the policy owner then made a $15,000 partial withdrawal. If the monthly mortality charge rate is $0. Per $1,000 of net amount at risk, what is the new monthly mortality charge, rounded to the nearest cent? A. $68.75. B. $63.13. C. $64.63. D. $75.38. The correct answer is A. The net amount at risk equals the $350,000 death benefit minus the adjusted cash value. $115,000 minus $15,000 equals $100,000. Dividing by $1,000 yields 100 units, multiplied by $0. 3 by 5 gives $27.50, but since there are actually 250 units, 350, 100 equals 250, the correct calculation is 250 multiplied by $0. Equals $68.75. Reason B is not correct. This value uses the net amount at risk before the withdrawal, failing to account for the $15,000 reduction in cash value. Reason C is not correct. This calculation applies the rate to 235 units instead of the correct 250 units after the withdrawal. Reason D is not correct. This result mistakenly applies the rate to the full death benefit without subtracting the cash value. Question 15. At the start of a policy year, Carter's universal life policy has a cash value of $90,000. The insurer declares interest crediting rates of 4% annual for the first half of the year and 3.5% for the second half, with interest compounded quarterly and credited to the cash value. What will the cash value be at year end, rounded to the nearest dollar? A. $93,415. B. $93,375. C. $93,150. D. $93,625. The correct answer is A. Interest is compounded quarterly at 1.00%, 4% marked 4 for the first 2 quarters, and 0.875%, 3.5% marked 4 for the last 2 quarters. The accumulation factor is 1.01. 2 multiplied by 1.00875. Tatu is approximately 1.03794, so $90,000 multiplied by 1.03794, approximately $93,415. Reason B is not correct. This figure reflects simple average interest over the year without accounting for quarterly compounding. Reason C is not correct. This value underestimates growth by applying the lower rate to both halves of the year. Reason D is not correct. This result overestimates growth by misapplying the higher rate throughout the entire year. Question 16. Which of the following is not an investment risk borne by a policyholder under a variable life policy's separate account provision? A. Market volatility reducing the cash value of accumulation units. B. Inflation diminishing the purchasing power of the separate account balance. C. Insurer insolvency affecting the protection of separate account assets. D. Interest rate fluctuations altering the value of accumulation units. The correct answer is C. The correct answer is that insurer insolvency risk is not borne by the policyholder because separate account assets are legally segregated and not available to general creditors in an insolvency. Reason A is not correct. Market volatility does reduce the cash value of accumulation units, so it is a risk borne by the policyholder. Reason B is not correct. Inflation can erode the purchasing power of the separate account balance, making it a policyholder risk. Reason D is not correct. Interest rate fluctuations do affect the value of accumulation units, which the policyholder bears. Question 17. The registration statement for the underlying separate account of a proposed variable life policy was declared effective yesterday. During a meeting today, a registered producer plans to present a summary of the policy and obtain the client's signature on the application, but the prospectus has not been delivered. Under the Securities Act of 1933, when must the producer deliver the prospectus to meet the delivery requirement? A. Upon policy delivery after contract issue. B. At the time the registration statement becomes effective. C. At or before the time the client signs the application and the sale is made. D. Within 5 business days following policy issuance. The correct answer is C. The Securities Act of 1933 requires delivery of the variable life prospectus at or before the point of sale, which occurs when the client signs the application and the sale is made. This ensures the client reviews required disclosure before committing. Reason A is not correct. It is incorrect because delivering upon policy delivery would occur after the sale, violating advanced disclosure rules. Reason B is not correct. It is incorrect because delivery at the registration statement's effective date does not satisfy the timing requirement relative to the sale. Reason D is not correct. It is incorrect because a post-issuance delivery window is too late under the prospectus delivery requirement. Question 18. Which of the following best describes when income payments begin for an immediate annuity? A. At the end of the annuity's accumulation phase. B. Exactly 1 year after the purchase date. C. Within 1 month of purchase. D. Upon reaching the contract owner's specified age. The correct answer is C. The correct answer is within 1 month of purchase because immediate annuities are designed to begin distributions shortly after the premium payment, typically one payment period, often 30 days, following contract issuance. Reason A is not correct. Immediate annuities do not have an accumulation phase. Payments commence soon after purchase. Reason B is not correct. A 1-year delay applies to deferred annuities, not immediate annuities. Reason D is not correct. The start of payments for an immediate annuity is not tied to the owner's age, but to a short period after purchase. Question 19. Maria, age 50, purchased a deferred fixed annuity with a 10-year accumulation period. She plans to withdraw funds during that period. Which statement about the accumulation period is most accurate? A. Withdrawals during the accumulation period are free of surrender charges. B. The insurer must start annuity payments immediately upon contract issue. C. Earnings grow tax-deferred until distributions begin at annuitization. D. Premium payments automatically stop once the accumulation period begins. The correct answer is C. The correct answer is that earnings accumulate on a tax-deferred basis during the accumulation period, and distributions are not made until annuitization. Reason A is not correct. Withdrawals made before annuitization typically incur surrender charges and tax penalties. Reason B is not correct. Immediate payments are not required until after the accumulation period at annuitization. Reason D is not correct. Premiums continue according to the payment schedule. They do not automatically cease at accumulation start. Question 20. Under a typical life insurance waiver of premium rider, which condition must be satisfied before the insurer begins waiving future policy premiums? A. Premium payments have been overdue for at least 3 months. B. Insured has reached the policy's maturity date. C. Insured remains continuously totally disabled through the elimination period. D. Insured provides annual proof of income tax returns. The correct answer is C. The waiver of premium rider activates only after the insured remains totally disabled for the specified elimination period, preventing waivers for brief or partial disabilities. Reason A is not correct. Overdue premiums do not activate the waiver rider. Reason B is not correct. Policy maturity is unrelated to triggering a disability waiver. Reason D is not correct. Tax returns are not required to trigger the waiver of premium rider. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.